Danny, Jared, welcome.
Good to see you, Peter.
Yeah, good to see you guys and have this conversation. So this is our quick mini dive into the transactions and pricing on the east side of Manhattan. Since coronavirus, and we're recording this mid to late summer, and so let's dive in with just a few of the questions that we get all the time. Who's buying right now? Danny, who are you seeing that is showing the most interest in buildings on the east side of Manhattan?
Sure. Who's buying right now? In terms of profile of buyer, I actually think it's the same of what we've always seen in the past. What I mean by that is you have the families, you still have syndicators, you have 1031 buyers, and you have foreign investors as well. The difference is right now, the people who seem to be paying the highest prices and coming in most competitively are actually the families, not the syndicators. And the reason being they're saying, hey, I'm gonna sit on this thing for probably at least 10 years, really committing to New York City for the long term. Whereas if you're raising money, you got to get in and kind of get out pretty quickly. A little bit tougher to make that happen in an environment like it is today.
Yeah, you have to make your promote. So basically, we were just looking right before we started recording here, and we were comparing the number of sales. And you asked me when the last time I saw this, and I hadn't seen sales numbers this low for the second quarter since 2009. I think the first half of 2009, the numbers were very similar, which is essentially you had almost nothing trade. And so what you're saying is that if the people who are like coming out of the woodwork and actually buying today are the ones who are going to buy for, they've got such a long-term mindset that they're identifying right now as just a time when they almost have to buy.
Yeah, exactly. And I will say though, the common theme amongst whatever profile buyer it is, they're all going to have to, they're going to have to be comfortable probably holding for at least 7 to 10 years, I'd say, no matter what, even if you're raising money. So if you're raising money, the equity has to be patient.
Right.
But we are seeing, I feel like when I say families, there's people, private families who've owned in Manhattan for a very long time, owned on the east side, would never buy in like a 2015 really hot peak market.
Right.
And now they're saying, hey, I can start to make sense of pricing again. So they're coming back into the market. And this is the point in the cycle where this profile of buyer really comes back in.
Yeah. Well, that's really helpful. So Jared, when we were talking about that and talking about pricing, it's almost like I'm seeing 3 different categories of cap rates emerge. If we had to just talk in, high level, every deal is very specific on its own, but we were just talking about a few examples. What would you notice in terms of cap rates?
Yeah. So, one other thing just to go off what Danny said is, the young syndicators and the families, the syndicators are still there. But what Danny noted, it's just much longer term capital. So right. My 3 to 5 to 7 year business plan, very, very hard to come by in New York City right now. Right. Your outlook needs to be 10 years at least. So based off that, really 3 categories, predominantly.
And let me, sorry to interrupt you, but I want to put the categories out there because I'm seeing pricing really separate in terms of buildings that are predominantly stabilized, buildings that are predominantly free market. And then you have a lot that are hybrid that have some free market and some for it is stabilized. But let's talk about, because we just did one of these transactions. We closed something on Catherine Street. Maybe on the location spectrum, not the best location in the Lower East Side area, but not the worst. But so that was predominantly stabilized. Like where are you seeing the market there?
Sure. So, the building on Catherine Street, predominantly rent stabilized. I would call that, Two Bridges area, pretty up and coming area. I think that area is going to look completely different, in 5 to 10 years, especially given everything going on, with COVID and the rent laws. For example, the retail there, they're bringing a tenant down that wouldn't have been there 5 years ago. So that area is completely changing. Yeah. That cap rate, north of a 6% cap rate. That's pretty much where I think the market is, considering where taxes are going to go up, and especially looking 3 months down the road with rentals, which I'm sure we'll get into today, that's going to be a much more challenged market, and buyers, need to be compensated justly for the risk that they're taking down there.
Yeah.
So
6, there's a lot of people who, if we were recording this 3 years ago, we were, saying 3 cap and, maybe a low 4. So for someone to hear a 6 cap on something that's predominantly stabilized, or north of a 6, still I think to certain people is shocking. But I just want to point out that the majority of this, the coronavirus and all the impacts that we're feeling right now, the virus itself, the economy, these are going to be temporary things that are going to come and they're going to impact us and they're going to eventually leave. The bigger impact relative to the pricing of a stabilized building really occurred because of what happened in June of 2019. Because now you have a stabilized building. If the economy does worse and the city needs to raise money and raise real estate taxes and other operating expenses, you have no way of raising your revenue. And that's why the cap rate has to be so high.
Right.
Danny, we a couple weeks ago, I think 2 weeks ago, we just put a building under contract on the east side on 19th Street. This one, mainly for free market, we had a totally different cap rate profile. Talk about that as an example.
Sure. This was a building that had been in the same family for about 40 or 50 years. 70% free market units. And what was interesting about this one, clean paperwork, which is obviously very important. The free market apartments were rented about 30% below market. So it wasn't just that it was predominantly free market. It was that, hey, you can come in here and you can jack these rents up, reduce these rents pretty quickly, and you have significant room to move them. As a result, it ended up going under contract for a 4 cap.
Right.
At about $630 a foot. So a 4 cap is not, that's a little bit of an outlier in today's market when you see the cap rate. So, the question is, what's the story and why would somebody pay a 4 cap? And that's why, because the immediate upside.
Yeah, well, that really speaks to what's happening in the market today, just, not only on the east side of Manhattan, but really all over New York, because it's very deal specific. And also within the buildings themselves, you could have 2 buildings side by side on the same street. They could look exactly the same. And depending on the nature of their rent roll, what's happening with their taxes, what the story is, how long it's been owned, all these things now start to have a much bigger impact on pricing. In many ways, I'm seeing it just in our business that's making, kind of really knowing what's happening a lot more valuable, both, from a seller standpoint, knowing how the buyers are going to receive it, and also, from a buyer standpoint, and making your business plan be successful, right?
Sure.
Yeah.
Sure. Another one to note on that on 19th Street is, that's a 40-footer that sold for, plus or minus 600 a foot.
Yeah.
So, there are people that are still willing to pay a premium for a lower basis, as we, especially downtown, especially on the east side, as we change more to, a yield driven environment, basis still plays an important role. And, if I can buy something at 600 a foot and, one thing changes or 2 things change and I can hold on for 10 years, I think that's a successful purchase right now.
Yeah. And you bring up a good point. You're talking about downtown locations. The fact of the matter is, at some point, people are going to want to come back. They're going to want to socialize. They're going to want all the, they're going to want to participate in all the things that make New York City fun, vibrant, and all that type of stuff. So it's a good point. Now, Danny, as far as the obstacles that we're seeing in the market right now, collections and demand, talk about that on the east side. You've had some anecdotes that we've shared of what owners are telling you about, what it's like on the ground today. And I think that would be really informative to the people who are listening.
Sure. Yeah. So collections is obviously a big talking point right now, but on the east side of Manhattan below 96th Street, for the most part, collections have been pretty good for residential tenants. The tenants who are in place seem to be paying rent.
Yeah.
Retail's a different story, but on the residential side, the tenants who are there are paying rent. The bigger issue is really tenants not renewing their leases, vacancy rates going way up. I was on the phone with an owner who owns probably 200 units on the Upper East Side. And he's got about 25 vacancies right now. And he said he usually has no more than about 5 to 7.
Right. And so the middle to middle back half of the summer, you're not supposed to have any vacancies.
Exactly.
Yeah, here we are. Here we are. Owners have spent years getting all of their leases on the summer cycle, and here we are. Everyone, the younger generation. I'm working from home until 2021. I'm out of the city. You had Jordan Sachs on your podcast at the beginning of this from Bold, and he basically said the leasing season is just extended by 3 months, and that's true. So,
It feels that way. It definitely feels that way. So how are you, Danny? How are you seeing owners adjust? Like what adjustments are they making that if let's say I'm an owner who's listening to this and I'm looking for just the best tactics that people have used to adjust. What are you seeing?
Sure. Well, on the rental side, for example, right? There's with vacancy being such an issue, with tenants not renewing their leases, what I seem to be hearing is that the landlords who really have relationships with their tenants. Now, I understand if you're a large landlord, you're not going to be able to, you don't have the time to know each one of your tenants. But those who know their tenants, who are having conversations with them and saying, "Hey, I understand this is tough for you. It's also, it's tough for everybody. Let's figure out a way to try to make this work." And maybe that means the landlord will need to offer a concession of some kind, like a free month of rent, or possibly even reduce the rent. But just reaching out, kind of that personal touch, sounds like that's actually been quite successful for a number of people.
Yeah, and I'd like to hear your opinion on this too, Jared. But I'd say one of the biggest surprises that has come up in terms of how important this has become during this time is the reputation of the owner themselves, the reputation of the owner with their tenants, the reputation of the owner with their borrowers or with their banks. If you're a buyer today, what your reputation is. So, it's kind of fascinating in a rising market or a very stable market. Everything looks the same. Everybody can perform. Everybody kind of does everything and it looks the same. But when you get into times like this, your reputation all of a sudden becomes very, very important, and it can make or lose you money. And we've had several stories shared to us on the good and the bad side about tenant relations and what the relationship is based on the reputation of the owner and how that relationship is with their tenants, and that really directly impact the performance of their asset. For sure, on the east side, I'd say it's even more so as you get out to the boroughs and stuff like this. What are you finding on the lending side, Jared?
Sure. So, if we were sitting here end of March, early April, it'd be a much different conversation, as we all know. And here we are midsummer. Things have opened up more. I think, obviously, mixed use buildings, anything with a retail component is a different story. And that's been a case by case basis with lenders, which it should be, and it will continue to be. I can tell you, I have a client on Avenue C who owns, a small 5 or 6 units over one retail. And he refinanced successfully. Yeah, he had a little bit, he had to put more cash up, and his, loan to cost was lower, but 6 months P&I and a little bit of escrow. So, banks are lending, and on straight multifamily, we spoke to a prominent managing director this morning, right? They are lending again. They are lending at strong terms. I think the rates are extremely favorable. He mentioned, anywhere from 3.5% to 4% for something multi, closer to the 3.5%. So the only thing that is a little bit different based off of, the past year is probably your debt coverage ratio, which is going to be closer to 1.25, 1.3%, depending on the type of asset.
Right. So it's less on loan to value and it's more on coverage ratio, and those coverage ratios have gone up a little bit. So, But as you said, even in those examples and what we were talking about, the buildings on the same street could be treated totally differently based
Sure,
on the nature of the tenants.
sure. You know,
All right. Well, look, we're gonna wrap up here, but Danny, I'll let you hit the last topic. Who's selling today? Why?
Who's selling today? I'd put the sellers into two different buckets. First bucket would be people who have owned an asset for at least 20 years, probably closer to 30 or 40. They've been through a few cycles. They've built up a lot of equity, and they were maybe already at the point in their life where they're thinking about retiring or doing something, or owning
a partnership or something, breaking up.
Yeah, so that was already, lifestyle had already dictated a potential change or sale, and then you have the rent laws passed, and then last June, and then you have the coronavirus. So it's been kind of a brutal 1-2 punch. But in addition to all that, it's really the political landscape, which you talked about earlier, Peter. It's the future of what the direction the state's going, and it just scares people when they think it's getting harder and harder to manage these buildings. If I'm thinking about selling a building, within the next, I'll put it this way: if I'm not going to hold it for another 5 years at least, it might be better to sell it today because it might get worse before it gets better.
Yeah.
So that's one. The other bucket would be, more on the syndication side, private equity groups who have purchased in New York, purchased multifamily over the last 3 or 4 years. So kind of got in when the market was hot, then the rent laws changed, and then coronavirus. And then, real estate taxes going up. So there's been just an assortment of headwinds. And they're saying, you know what? It might not be a function of distress. They may be able to get out and break even or even make a little bit of profit. But if their plan was, I'm going to come into New York, make a splash, and try to build some scale in this market, now they might be a little bit more scared of taking on New York because really of politics more than anything else.
Yeah. Yeah. So business plans that were just getting off the ground that they're not going to bring to full completion, but maybe they've got enough wind at their back where they can get out unhurt or maybe slightly hurt and just I guess pivot would be. But when you were mentioning the first part of your response, I almost feel like in this is a like real macro topic, as a theme that's come up from this is just time. So, who's buying? It's all about what's your relationship with the investment and time. Are you buying for the long term? And the sellers, they have a different relationship with time because you pointed out it's almost like the train had already left the station. We're going to sell. We've decided we're going to sell at some point in the near future, but we're not willing to hold for 7, 8, 9, 10 years. So it's interesting. Just as the concept, it's really the relationship between the investment, the person, and time, and that's kind of dictating what they're how they respond to what's happening on the ground. So
yeah, it's a great point. If you're thinking about retirement, maybe you're at an age where time's not on your side, right? So you can't wait it out. If you're going to buy and hand it down to the next generation, time is on your side, so you can wait it out.
Yeah. Well, Danny, Jared, thanks a lot to both of you. We will link to the East Side sales comps of the second quarter, and you can reach both of you guys. Will put your contact information and NewYorkMultifamily.com, and we'll talk to you guys soon. Thanks a lot.
Thanks, Peter.
All right. Thanks for having us.